Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark points out the gold-silver ratio is showing great promise for future performance. Trends Journal publisher Gerald Celente declares China is in a desperate situation as its stock market continues to plunge. We talk to Ross Clark right after this.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always a pleasure to be with you, Jim.
The Canadian dollar, of course, rides on the fate of the price of crude oil. So what is our near future for the loonie and crude?
Well, the loonie had a pretty good week here. We definitely had the advantage of the oil market pushing from below the Canadian dollar on the week up the better part of 2 cents at the best levels we have seen since this year as a whole, and you pretty much got to go back to the early part of December. We had some big exhaustion and oversold readings in January. Interestingly enough, when the oil market went back down and retested its low, the Canadian dollar held much better. A sign of good positive divergence there. Typically when you see the Canadian do opposite or diverge against the oil market in particular, like we saw here, we also saw the inverse of it at the top 2 years ago when the dollar was failing to match the strength that we were seeing in the commodities at the top end of the move. So, there's probably some more running room in the dollar. I wouldn't be surprised if there's a few more cents in here. But the oil market and part and parcel with that, the equity market, we've had just about everything moving in lockstep for weeks here. So when you've got a double bottom in oil, we invariably look at it and see we've got a double bottom in the equity market. At the tail end of the week, Thursday, the market tried to break out of the upper resistance in this double bottom that we've seen. And by Friday close, it looks as though it might be having a little bit of difficulty gaining some traction. So I wouldn't be surprised if we still go back down and make this more of a triple bottom as part of the seasonal pattern that we've been looking at. So the S&P, which ended off the week at 1948, still I think has the possibility of retesting under 1800 before we might see a better move up into April, May.
Is there hope for oil as spring hits and people start driving more?
Well, you definitely get the swing over to the gasoline side of the equation, and gas had a pretty good week. The seasonal in that one is the one that we like to take a look at. There is an ETF, an exchange-traded fund, that does participate in that. Now, it does have premiums already built into the market, so you need a reasonably good move in the underlying commodity to see a decent profit in the ETF. But that's one that we're taking advantage of this time of year.
You're taking a look at the gold-silver ratio, and it looks pretty promising, doesn't it?
You've had, since actually all the way back since April of 2011, when silver topped, and then subsequently later that summer the gold market topped, we have seen the gold-silver ratio just moving steadily in favor of gold. In this week in particular, significant action. The ratio is now up at 87 to 1. That is the highest level that we've seen since this move got started. It starts to put it into overbought territory. We take a look at the relative strength index on a daily, weekly, or monthly basis. All of them are starting to reach towards extremes. And we did some work back on the gold-silver ratio at the April 2011 high, and that helped us identify the top in silver at the time. And we've done additional work at this point to try and identify what we would look for when silver is ready to bottom out. And it would appear that we've got, I would say, a minimum of another 2 months before we can get one of the major signals. And by major, this is the type of thing that we've only got 6 signals since 1972, the type of thing that once you kick in, you're probably good for a number of years on the upside. But the pieces that we need are half in place at this point, another couple of months with considerable, or I wouldn't say considerable, but at least with a bias towards gold against silver. It doesn't have to be dramatic, but as long as the bias stays there, it could be enough that by the time we get into April, May, June, that we could be looking at a really good bottom for the silver market. And when, say, if that falls into place, it would fit in with what it would be the next normal period of seasonal strength for that sector, which is the one that takes us through the summer into September, early October.
Germany's finance minister has pleaded with the G20 to stop bringing on quantitative easing. They feel it's over, it's done with, let the markets go where they should.
Well, if you take a look at the various levels of stress in the financial system, we're at points now where QE1 and TARP came into place before, so I can see why there would be commentary coming out to say, please don't, do anything right now, because the pressure from behind the scenes must be getting to be quite big once again to come up with another QE4 or something to that effect. But, the lowering of interest rates clearly has not worked. We've got, $7 to $9 trillion worth of sovereign debt now around the world that's trading at negative interest rates, and that does nothing to stimulate. So I think if there is something out there to be done, it's going to have to be a totally different avenue, something that will be out of a different box.
I don't know, my suggestion was give every Canadian $1 million, see how that works.
Well, yeah, but make sure that it goes to home renovations, right?
Yeah. Oh, we've tried that too.
And that works because all of a sudden that money that's being spent, you need a tax receipt for it, and therefore the underground economy gets the knees knocked out from underneath it for a while.
Ross, thanks a lot for chatting with us.
It was a pleasure, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up, Gerald Celente on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Gerald Celente, publisher of the Trends Journal, available online at trendsjournal.com. He's speaking to us from historical Kingston, New York. Gerald, it's great to have you back on This Week in Money.
Always great being on with you. Thanks for having me.
Gerald, I have your newest copy of your Winter 2016 Trends Journal. What can people find in it, and where can they find out more about it?
Well, they could go to trendsresearch.com, trendsresearch.com. And, of course, the Trends Journal is a quarterly magazine, and it's 54 pages, full color, digital or hard copy. And we do a Trends in the News broadcast each weekday night, a 15-minute news broadcast of the trends shaping the future, the current events. And we have a Trends Monthly, which will be going out next week, actually, and every week a Trend Alert. So we really, of course, we also have Anthony Frieda's Trends Eye View of what's going on in the world, the famous illustrator, that are posted each week as well. So it's really the only place where you could read history before it happens. And again, the motto of the Trends Research Institute is think for yourself. So we just put the information out there, say why we believe what it is, and it's really up to you to decide what you believe and what you don't.
And Gerald, just to let people know how accurate the Trends Journal is, you were talking about the crisis in Ukraine long before it ever hit the mainstream media.
Oh, yeah, many months before. And as a matter of fact, when you go look at our top trends for 2016 that came out in early December, the first week of December 2015, we were talking about a global recession, and that was totally off the radar of the mainstream business news, and now, of course, they're all saying it. We also had forecast that the markets would unravel and go into bear territory in last year as well. We said it would happen near the end of the year, and it did. And we're in that critical point right now. We are looking at the MSCI World Index is in bear territory. You have emerging markets collapsing around us, currencies crashing, and commodity prices going down along with them. So the global recession is underway, and what we do is we also provide, suggestions for people to consider that are opportunities to seize and dangers to avoid.
Are gold and silver still in a positive trend?
Oh, definitely, as we see it, and gold more so, because gold, to us, again, we don't give investment advice. We're trend forecasters. It's the ultimate safe haven. And you look at the volatility going on in the markets. I mean, you go back to this past week, and they had the G20 meeting in Shanghai, China. Well, all of a sudden, the day that they're meeting, the Shanghai index collapses 6.5%. 6.5% as they're meeting. So they couldn't even control it. That's how out of control it is. And that was enough that should have shaken the world global markets, because you've been hearing it, Jim, as well as everybody else. The mainstream media, as the markets began to decline at the start of the new year, kept on going with the refrain, it's oil prices in China. Oil prices in China. That's all they could add, 1 and 1 and 2. That's all it was adding up to. Now China's going down. They don't mention China anymore. So now they're going, oil prices are going up, so the market's going up. Oil prices are only one of the many commodities in the Bloomberg Index. And when you look at the Bloomberg Commodity Index, it's fluctuating between 1999 and 1991 lows. So China, again, when you look at that equities market and you see what's going on there, and they're unable to stabilize it even as the G20 is meeting, you know that there are serious problems. The Shanghai index is trading around 2760. They were saying when it began to unravel last June that they were going to push it back up to 4500. They keep pumping out how great it's going in the United States. You look at the Nasdaq. The Nasdaq's trading around 4,500. It hit a high of 5,000 back in 2000, March 2000. So it's 500 points below where it was 16 years ago. So this whole market is nothing more than a Ponzi scheme. And gold and silver to me are the ultimate safe havens. And again, I like gold. Again, I'm not putting down silver. I don't know as much about silver as gold. I began buying gold in 1978. My first buy was $187.50 an ounce. And I say that because silver is also used in production, manufacturing, and we see a manufacturing slowdown. So that's why gold is going up percentage-wise a bit higher than silver as we see it.
Canada is reported to have sold off more of its gold. What are the likely repercussions of this?
Well, it's a desperation move. You're looking at when you look at the World Gold Council data in the last report, most of the central banks are buying up gold. So this is an act of desperation. As your loonies lost value, as the oil market starts to unravel and has continued to, I mean, everybody's cheering now, that Brent crude is back up to $35 a barrel. I mean, you go back to 2014, June, and we were talking about Brent selling for $114 a barrel. So there's still a lot of problems in the oil area, and you're going to start seeing a lot of bankruptcies and banks going down with them. Matter of fact, when you look at the banking sector, you saw banks such as Deutsche Bank, Societe Generale, Citi, and others, losing between 27 and 40% of their value, stock value, just since the start of the year. And you know that saying, follow the money. Money makes the world go round. The banks are in trouble. Or at least their shares are, and their share values to us going down is all their exposure, not only into oil, but in the global marketplace. When all that money was borrowed, all that cheap money flowing out of the States during the quantitative easing years that went into the emerging markets, and now their currencies are declining, and corporations and countries borrowed so much money, now they have to pay it back with declining currencies in dollars. So the banks are exposed throughout in many different sectors beyond oil and mining, whether it's farmland, it keeps going, and all of the ancillary supportive elements that grew those commodity sectors they're exposed to. So that's why you're seeing the banking stocks taking such a hit.
Did the Dow and the S&P 500 just complete a double bottom correction, and are they likely to climb a wall of worry or head lower over the next few months?
I don't know, and that's really not my expertise. But as we see it, the Dow, when you look at the real data, the stock valuations are still around, 21% or 21 times greater than earnings. And so they're still way too high. And the reports on earnings are inflated. There was just a story that came out in the Wall Street Journal a few days ago showing how inflated they really are when you put regular accounting practices into place. So they're actually down to S&P numbers on the top 500 earning companies are down to 2008 levels in real earnings. So we don't see a correction of any sorts that's going to have any legs. But again, the markets are manipulated, and I don't say that as a conspiracy theory. We know, in fact, that the LIBOR rates, the interest rates, the forex markets, the currency markets have been manipulated. The banks were forced to pay major fines, chump change, of course, in terms of what they stole, considering that just in the forex market it's traded at $3.5 trillion a day. But 6 banks were convicted of felonies in those areas. So I have no doubt in my mind that these markets are manipulated, particularly when you watched what happened in Davos in mid-January, when all of a sudden you heard from the hedge fund chief of Bridgewater Associates, the largest hedge funds in the world, call for more stimulus. And then the very next day, Mario Draghi, also at Davos, the ECB president, saying that the ECB was going to consider stimulus measures in March. And so the market shot up. So I have very little faith in the fundamentals of the markets because they have been totally disconnected from true price discovery and supply and demand equations.
Is the U.S. economy experiencing real growth?
Well, the GDP numbers came out for the last quarter, and they grew the grand total of 1%. That's nothing. And who believes that number anyway? So you look at the real data going on, and you look at the job numbers. Oh, we have low unemployment. Yeah, it's because they don't count anybody once they're off the unemployment rolls and can't find a job. And then you look at the jobs that have been created. Yeah, this is a real number, Jim. Half of all working Americans, over half, are earning under $30,000 a year. So the jobs they're creating don't pay a living wage. There is no recovery. It's a cover-up. 1% of the population gained 95% of all the wealth created since they began quantitative easing and zero interest rate policy in 2009. Those are facts.
Is the bond market experiencing a so-called new normal?
Who would believe that $7 trillion in government bonds right now are paying negative interest rates? Negative interest rates, negative yields rather. So if you loan me money, I'm going to pay you back less than you loaned me in 10 years, 5 years, whatever. The bond matures. This has never happened in the world, in the history of the world. So the new normal is that everything is abnormal. And you have abnormal people making abnormal policies such as negative interest rates and negative bond yields. And they're getting away with it. That shows you the level of desperation on one end and the level of incompetence on the other end.
Gerald, is China depegging from the U.S. dollar a huge story?
Well, yes and no, in the sense that, China's in a very desperate situation. Their overall debt level from just about 20 years ago went from about $500 billion in total private and corporate debt to now $30 trillion. As the yuan continues to devalue, you're looking at capital outflows out of China. They're in the levels of $100 billion a month, more. That's official. They have to stop the outflows. And as a matter of fact, you can see where that outflow is going. It's a China boomtown in a town near you. If it's a good place to go, and you look at all the money going out, they just bought up the largest dairy company in Australia, and they're buying up agricultural products, land rather, and operations, at record numbers. Matter of fact, they own Smithfield Farms over here in the United States, one of the world's largest pork producers. And so they're buying up, particularly in agriculture and any other valuable assets that they can see, so the money is leaving the country. A lot of these deals, by the way, are also government-backed. They're government companies with fake names in front of them to disguise that they're owned by the Chinese government. But the real problem with China is that they're facing a real debt crisis. It's just ballooning, and they're very concerned about a devalued yuan. And you have the people in the media and the business media saying that China is purposely devaluing it so that they could export more product. Well, when you look at the real data, particularly in the emerging markets where their currencies are collapsing, on average their exports are down 12%, even with currencies that are at record lows. There's too much demand and not enough supply, too much supply rather, and not enough demand of product. So they can lower that yuan all they want. Will it increase exports? Still to a marginal level. Nothing to make a difference, but it'll cost them more to live. So they're not devaluing on purpose. They're in a bind. And matter of fact, now they're going to be putting more stimulus into the economy and trying to pump it up, so they're building the bubble even bigger. They're in a real catch-22. They don't know what to do. Again, we're in an unprecedented time in history. No one ever heard of quantitative easing before. This happened, in 2009. No one ever heard of zero interest rate policy, and no one's ever heard of negative interest rate policy. So it's just a freak show, and the freaks are running it.
Do you think we'll see another round of quantitative easing?
Very possibly. Very possibly. You're going to start seeing it coming out of Europe, and it could well happen here. They could do anything goes. They'll make up any excuse. Look what happened after 9/11. People forget the United States was in a recession. They lowered interest rates to 46-year lows. It created the housing bubble. So what they do is they use a terrorist strike or geopolitical incident as an excuse to implement unsound economic policies to keep the Ponzi scheme going. So we could have stimulus. Something could happen. A terrorist strike, false flag or real, whatever it might be, credit crisis, and they'll come out with it again and they'll get away with it.
The Bank of Japan has adopted negative interest rates. I've heard the reaction has been people have withdrawn their cash from banks and are keeping it at home. They've run out of safes to keep it in, so maybe they're just putting it under their futons. Do negative interest rates work in propping up economies?
No, and they haven't worked at all. And there's no proof that they do. Again, it's never been done before in history. And you saw the reactions, what happened in the markets. I mean, after the market initially went up, after January 29th, when they announced negative interest rates, the Nikkei started to collapse. And it's gone up a little bit, but and the banking sector is down into bear market in Japan on the share levels. So no, it hasn't done it. And also, it's not in the best interest of the banks, the private banks, to have such low interest rates because they can't loan money out and make a profit on it. So that's why they're concerned about negative interest rates. It's cut into their profit margin. And what does it do? It's supposed to stimulate the economy. But after all, how much more failure does Japan have to face? 2 rounds of Abenomics didn't do it. All it did was temporarily boost the equity markets. Could anybody add minus 1.5% GDP growth in the last quarter? I mean, can't people look at that number and call it a fact? Because that's what happened in Japan, despite their schemes. It's not working. It hasn't worked, and it won't work.
The possibility England may vote to exit the European Union and the upcoming movie London Has Fallen, does that show that there's actually a trend happening in jolly old England?
It's happening across Europe, whether it's the Brexit, leaving the Eurozone, or whether it's ending the Schengen agreement where you have open borders between Eurozone nations where people could travel across them because of the migration and refugee crisis. And you're seeing the emergence of more and more so-called populist and nationalist parties. It's a trend, and that's only part of it coming out of the UK. And again, when you look, you go to Germany, they have the AfD party, that's a populist party that's gaining a lot of the Alternative for Germany party. it's called a populist movement, but it's an anti-immigration movement, and it's a pro-nationalist movement. And you're going to start seeing that in more and more places. It's happening in France, of course, and it's happening in Italy with the Five-Star Movement, and it's happened to some extent in Spain with their parties as well. And we see it continuing, and what's going on in England is just one of the symptoms of that dialing back of countries wanting to maintain their national identity.
Does the Baltic Dry Index, which measures the amount of cargo being shipped around the world, continue to warn of bad times ahead?
Right now, it's at its all-time low level since they've been reporting since 1985. And you also look at the Cape-size ships, the largest ships. They need something like $20,000 a day to operate, and they're sending them across it and making $2,500 a day. They're desperate for any kind of revenue income because their debt levels are so high. It's a very accurate indicator. And it's also when you're looking at the activity at ports around the world and how it's declining so much, and all the ships, particularly in Singapore, that are moored out there, just doing nothing and, waiting for some kind of action to happen. So no, it's a very accurate indicator. And when you look at listen to the chairman of Mazurk Lines saying it's worse than it was than it was in 2008. People should stand up and listen. I mean, the guy's not going to be saying this, as a bluff. He's saying how bad profits are and how the company is suffering from it. So, obviously saying something like that's not in their best interest, but he's saying it because it's a fact.
Even in bad times, if you're on the right side of the markets, you can make money. What markets do you focus on during bad times?
Well, I'm not really a market guy. That's not one of my fortes. And, but for me, I'm just, I'm kind of simple in that direction. I just buy gold, and of course I buy real estate. But the real estate I buy, I own some, 3 of the most historic buildings on the most historic corner in the United States. So I do it out of passion and beauty and art, and I don't do it as of course I want to make money on them, but I just have different motives. So I have a very thriving business, and that's where my energies go into. So I'm not really a good stock picker. It's never been my forte.
Do you think the military-industrial complex sector of the stock market will continue to see growth for the remainder of this decade?
It's hard to say for the remainder of the decade. If we have a real peace movement, it can slow it down. But as things stand now, I believe that the sector is going to continue to grow as the war drums keep beating louder. And when you listen to the presidential candidates, for example, here in the United States on the presidential reality show, they all talk about more bombing, more torture, more imperialism. So I would say that with the destabilization growing in the Middle East, I would say its military-industrial complex will be one of the growth industries.
The global vehicle fleet continues to become more fuel efficient, and the U.S. is becoming self-sufficient for oil. Could those trends keep the price of oil low and could diminish the need to go to war for oil?
I don't think we'll be going to war for oil anymore, but there's no question about it. There's too much supply and not enough demand. As a matter of fact, pretty soon the United States, just in a couple of years, will be producing more oil and gas than Saudi Arabia and Russia. And who would have ever thought that back in 2005? And at the same time, you're looking at more and more alternative energy developments beyond wind, solar, geothermal, and biofuel. So our long-term forecast for oil, in the absence of a major global conflict, is for prices. Our mark has been around between the $40 and $30 range, and that's where we see it staying in for a while.
What kind of an effect will that have on the U.S. dollar, the so-called petrodollar?
Well, it's kind of in a different field in that element, because the only reason the dollar is gaining any strength at all is basically because the other ones have become so weak. It's not because of the strength of what's going on here when you look at the Purchasing Managers Index and other data that shows how weak the economy really is. I mean, they keep talking about the housing market, new home sales. I mean, the new home sales were, they're under 500,000 a year. At the height of the the boom in 2006, they were at like 1.23 million a year. So we don't see, much of a fluctuation from where we are right now in those kind of fields. And it's more of the same but worse, is to sum it up.
Are the currency, stock, bond, and commodity markets likely to see more volatility and possibly violent moves leading up to the November presidential election?
We don't really think the presidential election is going to have much of an impact in the markets. Go back to 2008. 2008. We were going into one of the worst financial crises since the Great Depression. It did not change the course of the presidential election. The president had no power over changing the course. And we believe the same events are going on now. It's beyond their control. I believe that on the war front, for example, you won't see more war talk or war action until after the election. And I say that based on knowledge of the past, because tracking trends is an understanding of where we are, how we got here, and where we're going. So you look back to the presidential elections in the United States, going back to World War I. You had Woodrow Wilson. I always say 6 words killed America: Harvard, Princeton, Yale, bullets, bombs, and banks. He was the president of Princeton, promised Americans he wouldn't take us to war in World War I, and he did after the election. Franklin Roosevelt promised Americans he would not take us to war, and he did after the election. Lyndon Johnson promised not to escalate the Vietnam War. He did after the election. Tricky Dick Nixon: I got a plan to get us out of Vietnam. As soon as he got elected, he ramped it up, started bombing Cambodia and Laos. They wait till after the election. And to me, it's post-election where you're going to see most of the volatility. I don't believe anything going on now in either party will have any influence on the economic end. It's out of their control. The markets are going to take their own course regardless of what any presidential hopeful, wannabe, or will be says, does, or wants. But on the war front, wait till after the election.
Is there any particular candidate that would be better for Canada?
Nah. Both candidates, both parties, they're murderers and thieves, If the interest in Canada is in more immorality, then they're safe with either party. But if they want to move to higher levels of advancement, spiritually, emotionally, and and morally, then whoever wins, everybody loses. It's just more of the same with different names.
Who do you think's most likely to win the presidency, and could electronic voting machines play a role in that?
We don't think the electronic voting machines will, and particularly now that Anthony Scalia is gone. He's the guy that stopped the vote count in Florida when they were going to have a new one when there was back in 2000 when Gore and Bush were running, and Gore was winning Florida and he stopped the vote count. So I don't think that's going to happen, but I'm sorry, the other part of the question, I just blanked out on it.
Well, we were just wondering, who do you think would win?
Who do I think is going to win?
Yeah.
The wild card. Donald Trump is the wild card. I mean, when we came out with our magazine last April, the cover was the presidential reality show, Liars, Cowards, Freaks, and Fools. And that's before Trump got in the race. So he's the wild card. But as we see it now, we believe that Hillary Clinton has the best shot in the race at this point.
If World War III happens, do you think it will be a religious war? And if so, what will the atheists do?
Well, in my book, Trends 2000, which came out in 1996, I wrote about Crusades 2000. You're waking up in the new millennium. And that's really all this is. It's the 10th Crusade. And nothing really has changed. But the basis of the wars aren't really religion. They use that as an excuse. So, for example, you can talk about Islamic fundamentalists. Well, let's put this in perspective. Let's just say a foreign nation, we'll call the foreign nation Iraq, and they invade Canada because they don't like what's going on over there, and they think that you're a danger to the world. And they blow up Vancouver, Montreal, Toronto. They destroy the entire nation. They kill over 1 million people, and everyone you love is dead, and your country is destroyed, and you're a young person. You think you're going to be radicalized? So we'll call them radical Christians. So what I'm saying is they've created they've created the groundwork for hatred, and to simplify this as a war against radical Islamists, even giving it that name, rather than a war that has begun because of imperialism and mass murder committed against millions of innocent people. So it's really only about psychopaths launching nations into war, and usually the bottom line is money. Because would have America invaded Iraq if their major export was broccoli? You'd think they'd be in Libya and haven't destroyed that if it wasn't for oil. And anybody could go and do the research themselves and look at the email exchanges between Sarkozy when he was launching the overthrow of Assad and their oil interests in the emails to Hillary Clinton that had been released when she was Secretary of State. So oil was the bottom line. Religion becomes the selling line.
There's a growing trend to use robots. How is this going to affect the markets and jobs for people?
Well, we're going from a period of industrialization to robotization. It's you could call it an advancement or a decline, whatever it is, it's real. And you're going to start seeing more and more of it. And so the industrial age, it had its time, and now we're going into the robot age. And interestingly enough, pretty soon you're going to have robots controlling people, because the people are turning into robots already. And when you see how addicted they are to their electronic devices, so who knows where this thing is going to go. The brave new world may be run by robots, but they're not going anywhere. They're just going to keep growing. So people without the skills to advance are going to definitely lose jobs in a lot of areas. And look at the jobs that are being created now. What do you go to college for? To get a degree in packaging and shipping, so you can work for Amazon? So those kind of jobs are going to be lost, in manufacturing jobs, particularly, assembly line type of jobs that still exist to some extent or another. So there's no question that robotization is going to replace industrialization.
Boomers are starting to turn 70. What effect is this going to have on the markets over the next 15 years?
Well, the markets right now, when you even look at it in the market term, the average player is gone. It's an algorithm game. Hedge funds, private equity groups. The common person is, it's not China. We have 80% of the investors are in the retail market end. It's a different world. So as for the boomers, this is the last generation that really has pensions and benefits and any type of security. But even at that level, it's not where it used to be. When you compare it even down to 2005 levels, the boomers are in much more debt and have a lot less savings than than retirees back in 10, 12 years ago. So the boomer market is going to be, in terms of servicing that market, is that they don't want to end up as inmates in nursing homes. And again, the first wave of them is going to turn 70. They are turning 70 this year. So there's going to be a lot of need for products and services to service this group. And it's going to break into different groups. There's going to be the very healthy, the unhealthy, and the moderately healthy. And each one of those sectors are going to have special needs and special wants. So it's a huge marketplace, because they also, as bad as the rest of the economy is doing, particularly among the millennials who can't find good work and are deep in debt, the boomers still have more disposable income than most. So that's really a market sector to key in on.
Do the habits of the millennials, born from 1982 to 2000, differ from the boomers, and are they likely to affect and change markets?
Well, they're much different. They grew up at a very different time. The boomers were a very fortunate group. I mean, I'm the leading edge. I was born in 46. I was born into the height of prosperity in America. It's a whole different world. The millennials have no reference points of what the past used to be. So, for example, when I was a kid, there were no Walmarts. There were family stores. There were neighborhoods. They had a thing called stationery stores before Staples and Office Depot. We had hardware stores before Lowe's and Home Depot. So the millennials have very few reference points. They have a very narrow outlook toward life. And it's not a pejorative statement, it's a factual statement. You don't know what it was like, for example, to ride every day in a horse and buggy or ride a horse unless you did it, or before you had refrigeration and you were using ice. So they don't have a lot of reference points, and they're born into a very, very concentrated time where opportunities are very thin, multinationals are very big, and opportunities are very limited. So unfortunately, they have a very, very rough road ahead of them, particularly when you look at the college-educated sector, and then beginning life at a young person in their early 20s with what? $60, $70, $80, $100,000 in debt? Who could imagine that?
Gerald, how can people get the Trends Journal again?
Trendsresearch.com, trendsresearch.com. And, of course, it's a money-back guarantee. We say it's the only place where you're going to read history before it happens. Trendsresearch.com.
Gerald, thanks a lot for being on This Week in Money.
Hey, thank you, Jim.
My guest has been Gerald Celente, publisher of the Trends Journal. He's been speaking to us from historic Kingston, New York. And that wraps up our show for this week. Thanks to our guests, Gerald Celente and Ross Clark, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.